What is a proxy fight? To understand proxy fights, also known as proxy contests and proxy battles, one must understand the standard corporate dynamic, where the corporation is directed by the board of directors, who in turn select the corporate officers. And yet it is the shareholders who ultimately hold the power over selecting those directors. So whereas the directors and the corporate officers are operating the company and overseeing its long-term direction, it is the shareholders who have ultimate power. But that is not ultimate power on a day-to-day basis. And as such, when those shareholders are seeking to make changes, whether it's to the board of directors, the direction of the company, or major fundamental changes within the business, and this is being opposed by the current slated directors and in turn by the corporate officers, then we run into conflicting situations, which oftentimes has led to proxy fights, where two forces are butting heads with one another and trying to ascertain what direction the corporation will ultimately take. As such, in most proxy fights, the challengers will oppose a slate of nominees proposed by the incumbents for the election of the board of directors. Such proxy fights are known as control contests, since they involve challengers trying to wrest control from the incumbents of the board of directors and thereby attain control over the direction and management of the corporation. The other common area of proxy fights deals with fundamental corporate changes, such as proposed mergers or anti-takeover charter amendments, where certain shareholders may be challenging the decisions or the suggestions put forward by the board of directors and attempting to either change them or to do away with them in their entirety. Proxy contests and proxy battles are an important element to the corporate structure and continue to be ever present in the direction of most corporate management. Control contests are the only alternative to hostile takeover. Proxy fights have played an increasingly important role in determining the direction of corporations as they move forward. With respect to control contests, they often are the only alternative to a hostile takeover for replacing the current management of the corporation, such that they are attempting to unseat the current board of directors. As the impediments to takeovers have grown, control contests have become increasingly common. Similarly, with respect to issue contests, these have increased in significance, in particular as institutional investors have become ever more interested in the question of corporate governance and the decisions that could impact their investment. In many respects, the value of a company's assets depends significantly on who directs and manages that company. Therefore, it is highly desirable to retain a board of directors and corporate officers who will deploy the corporate assets in a way that maximizes corporate value. Furthermore, the incumbent board of directors and corporate officers tend to be disinclined to relinquish control, even if it is to better individuals. The incumbents tend to have self-interested motives for maintaining control. They want to retain the private benefits, such as high salaries and perks, that are associated with exercising control. Their interest in preserving their own control might exceed any interest they have in letting better directors and better corporate officers run the company. Thus, it is important to facilitate beneficial control changes in spite of the opposition that might be put forward by the incumbent board of directors and supported by the corporate officers. From a societal perspective, facilitating such changes will have two desirable consequences. The beneficial change itself will increase the value of the company ex post, and the threat of losing control may well provide ex ante incentives for incumbents to increase the value of the company. Changes in control against the incumbent board of directors opposition can occur in basically two ways. One, through a proxy fight for control, and two, through a hostile takeover. By hostile takeovers, one talks of the acquisition of a controlling interest without approval of the incumbent board of directors, whether through a tender offer or through a series of open market and privately negotiated share purchase. Control contests and hostile takeovers employ different mechanisms for transferring control. In a control contest, the challenger tries to persuade existing shareholders that they would manage the company better than the incumbents, primarily the board of directors and corporate officers. In hostile takeovers, the corporate raider offers to buy the shares of the other shareholders. As can be seen, the relative advantage and disadvantage of control contests versus hostile takeovers stems from this difference. If control contests could be relied on to work perfectly, they would, for a number of reasons, generally be the superior tool for replacing the incumbent board of directors and, if necessary, corporate officers. First, hostile takeovers tend to involve higher transaction costs than do control contests. Hostile takeovers, unlike control contests, necessitate a significant change in the ownership, as opposed to merely the management, typically at the board of directors level of the company. As there is no inherent reason to acquire a company whenever one attempts to effect a change in its control, the transaction costs involved in acquiring a controlling interest and to arrange the financing for the acquisition are generally wasted. Second, the changes in property rights involved in hostile takeovers can distort shareholder choice of whether to sell their shares to the hostile takeover's leader. This distortion can take two forms. Shareholders may attempt to take a free ride and effectively refuse to tender their shares, or they may be pressured to tender their shares when they would not otherwise do so. Free riding attempts can occur when a shareholder is faced with a bid by a corporate takeover leader under whose control the value of the shareholder's shares would increase. In such a case, a shareholder may reject a bid and retain their shares even though the offered price is above present share value, hoping to free ride on even larger increases in the value of their shares when the takeover leader takes control. By contrast, pressure to tender can arise when a shareholder is faced with a bid by a takeover leader under whose control the value of the shares would decline. Shareholders may find themselves pressured to accept such a bid even at a price below the present share value if this price exceeds the expected value of minority shares after the corporate takeover leader has taken control. Thus, free riding can lead to the failure of desirable takeover bids and pressure to tender to the success of undesirable takeover bids. A third shortcoming of hostile takeovers that acquiring sufficient shares to stage a hostile takeover can trigger anti-takeover devices. For example, poison pills, which grant shareholders other than the takeover leadership the right to buy treasury shares at a substantial discount, could greatly reduce the value of the takeover leadership's holdings. Or anti-takeover charter provisions could restrict the ability of the takeover leadership to gain control of a company or use their control to effect changes in the corporate structure. Because such devices make acquiring a controlling interest against the will of incumbents more expensive or less profitable, they both lower the incentive for corporate takeover leaders to attempt hostile takeovers and reduce the likelihood of success of those hostile bids that are launched. Transaction costs, distorted choice, and anti-takeover devices constitute significant drawbacks to hostile takeovers. But controlled contests too suffer from severe imperfections. There are two main causes for these imperfections: inadequate incentives to acquire information and inadequate incentives to lead contests. Proxy fights, proxy contests, those outcomes are imperfect primarily because shareholders have inadequate incentive to ascertain which contestant is superior. This lack of proper incentive is caused in two distinct ways: by the dispersion of share ownership. First, shareholders who own only a small fraction of the company's shares will not be affected greatly by the outcome of the proxy fight. That is, even a large increase in company value could result in only a small increase in wealth for such shareholders. Second, these shareholders will consider it unlikely that their few votes will affect the outcome of the control contest. For both these reasons, such shareholders will have little reason to acquire information about the contestants. As a result, a shareholder's lack of incentive to become informed, inferior contestants will often emerge from proxy fights as winners. By contrast, information incentive problems have less of an impact on hostile takeovers. One reason is that shareholders need less information to decide whether to tender than to decide how to vote. Rather than having to evaluate the management abilities of incumbents and challengers, they merely have to compare the bid by the corporate takeover leadership with the current value and share price of the company. In addition, the shareholders will face greater incentives to acquire information. To be sure, the outcome of a tender offer may not greatly affect shareholder wealth, and an individual shareholder's decision to tender may not greatly affect whether the offer succeeds. But whether a shareholder tenders their shares will be significant to them, even if it does not determine the success of the bid, and thus provides an incentive to acquire information. If the bid succeeds, a tendering shareholder will receive the price offered by the corporate takeover leadership. A non-tendering shareholder, on the other hand, will retain their shares. Inadequate incentives to acquire information and the resulting imperfection in the outcome of control contests pose a second and related problem. The possibility that a good contestant may lose the contest makes it less worthwhile for that contestant to enter the contest. But the possibility that a bad contestant may win the contest makes it more worthwhile for the bad contestant to enter. That is, contestants will be subject to imperfect incentives to enter contests. As a result of these imperfect incentives, proxy challenges do not always arise whenever they are desirable, and sometimes arise when they are undesirable. Moreover, good contestants are not always compensated for the cost of leading controlled contests. If so, they bear all the costs of waging a contest, but must share proportionally with all other shareholders any increase in company value resulting from a successful contest. The risk of not being reimbursed further reduces incentives for good contestants to wage proxy contests. Meanwhile, as takeover defenses continue to proliferate and grow in sophistication, it becomes more difficult for hostile bids to succeed. By contrast, the growth in institutional investment has reduced the dispersion of share ownership and ameliorated the information incentive problems of proxy contests. Thus, proxy contests have reemerged as an important tool for acquiring control. In light of the renewed significance of proxy fights and proxy contests, it is important to stress that their imperfections are only in part inherent in the nature of proxy fights. Additionally, the extent of these imperfections is a function of the legal rules governing proxy fights. Nonetheless, with the importance of proxy fights to the shaping and determination of the direction and control of corporations moving forward, proxy fights continue to play an ever-increasing role in the advancement of corporations and their decision-making processes. Thank you.